Okay, it's 11 o'clock. We'll get going. There's a bit of news to run through this morning. I'm doing some, Richard Williamson will be doing some. And our guest this week is Samantha Fitzpatrick, who's one of the managers of Murray International. So we'll be talking to her in a bit. News-wise, you can see there's 5 things we pulled out there. Foresight Solar first. As with all of these renewable energy funds, everything was looking great until interest rates started to go up. And then quite quickly, the share price started to derate. And even though rates have been coming down, the share price is not recovering. The discount's got wider and wider. So at some point, the elastic has to snap. And you can see this is the whole sector ranked by dividend yield, actually. I just thought that was interesting. I think 10.5% is a daft level, really. You can't get that on almost anything. And these dividends are fairly safe, as I keep saying. So it just seems extreme. And I think the board now agrees with this. And then this one just ranks it by the 10-year NAV returns, because there are a clutch of these funds that are more than 10 years old. So we've got long enough history of them to see what they're like over a long time. And it's not too bad. And then if you look at the 5-year numbers, I think it ranks second in that group there. So there's nothing really wrong with what it's doing. Nothing's sort of gone wrong. What they've published on the 18th was their end of December NAV, quarterly update. And the thing was all miserable for a good reason. It's been the most overcast year in the UK since the company started, for quite a while since. The generation was 7% below budget. But that sounds bad. That's not the end of the world there, really. 7% is probably at extreme levels, I think. Selling the portfolio they've got in Australia, which basically was a bit more simple and was all free up some cash. They were targeting an 8p dividend for the year, and that's all totally fine. They're targeting, one of the weird things they've done is they've said the target dividend cover for 2025 is 1.3 times, but they haven't actually set what the level of dividend is yet. So maybe they're going to kind of reverse engineer that. But we're not expecting a cut or anything like that. The whole thing sort of keeps marching on. And then because of the discount, they have been buying back stock. Now, so far they've bought about £40 million worth, which is not too bad. But obviously that's sort of slowed a bit more recently. And maybe with the Australian money, they're going to do something already. What the board has done, first thing is to reduce the fee. So they've changed it. We saw this happen the other day on a different run, but it's now the average of market cap and NAV as the base, and they've just pulled down the percentages as well. What was 1% becomes 0.95, and what was 0.9 becomes 0.8. And that saves them about £1.2 million if you add the current share price discount persisting. Obviously, that's not the point of this exercise. They do want to get the discount down. The only thing is, it's a slightly odd in that, obviously, if it went back to trading at premium, then they get more money than they do at the moment. But that doesn't really sit well with me, but we're not there yet. We're running it for a while. So the board has said, look, we've been talking to shareholders, we realise that some of them are quite upset. Some of them are just saying, we want money back. And others are saying, we need just a bigger, more liquid funds here. So really calling for mergers and things. And the board's looking into all of this and taking this seriously. So the implication here is that you would get a sort of choice of cash and a merger with another company. It's not easy to get cash out of these portfolios. If you just create a realization pool and put a slice of the assets in there, there are deals that can be done buying with the ongoing pool, depending on how big that is. But you could be waiting a very long time to get your money back, as the sort of extended experience has shown. So, it's a start, and the share price has moved up a little bit, but we need to see what concrete action here to see what's going to happen. Now, in terms of what concrete action that might happen, we've got a new IPO, which is obviously quite exciting because we haven't had an IPO for ages. It's not very big, £54 million. But nevertheless, that doesn't mean it won't be able to do stuff. It starts trading next Tuesday. It's on the specialist fund segment, so that means many people won't be able to buy it, and maybe you would want to anyway. It's going to have quite a focused portfolio, just 2 positions probably, but up to 5, and that's the reason it has to go on the specialist fund segment, because it's not appropriately diversified for a main listing. But nevertheless, I don't think that should necessarily be a criterion. That's one of the things we would quite like to get rid of, is the specialist fund segment, if we merge everything together. The managers are Rob Naylor and Chris Mills. And you'd know them because they were involved in sorting out hypnosis. They've Robert's involved with Roundhill Music. Chris has been involved with Rob on PRS REIT, which Rich has talked about here before. So the idea is they will pick a couple of alternative assets funds, things that in property, infrastructure, renewables, private equity, that sort of stuff, trading at big discounts, try and do something constructive with them to address the discount. So in terms of their fees, 1% base fee on 54 million isn't a huge amount of money by the time you sort of run the cost of the management company. So the upside for them is the performance fee, which is 10% of everything they make over 10% above the in price. The real important thing to get across here is that the big difference between this and something like Saba is that it's been really called for and backed with hard cash money by frustrated investors in these things that want to see these discounts close. So we've all tried very hard to draw up interest in them. We've all tried very hard to campaign for a resolution to disclosure problem. We've all tried very hard to get the government to take the general decline of the UK equity market seriously. Nothing's really happening. And so it's kind of inevitable that somebody's going to come along and start beating things up. So watch this space, really. And then obviously in terms of fund that we do love and has just recently survived a cyber attack is Herald. And you can see how the discounts widened out since it won the vote. But it's kind of back to where it was before. It's not excessive at all. And the question is, what happens next? The results that came out this week were good, I thought. I mean, they're fighting against a dreadful headwind in terms of the UK equity market, which is about a third of the fund, more or less. And you can see the return on the Dutch US investment companies index was only 5%. The returns on the American stocks were much, much higher, and that's what Saba would have you sort of look at. But obviously, it does hold American stocks, and to the extent it holds American stocks, it outperformed that. There's nothing really wrong with what this fund is doing. And also, they bought back a lot of stock last year, partly because to Saba, partly because they were doing it anyway. They bought back well over £400 million worth of stock since it got going. So the important thing here, and the thing we want to flag, there is an AGM coming up on 24th of March. Every 3 years they have a continuation vote, but may have been selling stock and not disclosing it because we felt, I mean, can't pinpoint it, but we felt that it's been quite bad at disclosing things when it's supposed to, and I think I'd really like we should look into that. But it might still own 29% of the company. It's a straightforward 50-50 vote. So it's going to be really important to make sure you vote in favour of continuation if you're a shareholder, because otherwise Saba could kind of win by the back door. As we well rehearsed on this, we know that you have to get in touch with your platform and get your votes in early. So well before the 20th of March. Vote early, as I say that. Right, that's enough for me. Let's talk to Richard.
Thanks, James. So a lot going on again in property in M&A, as usual, as we've seen over the last couple of years. And so this week, Assura, which is the healthcare REIT, which owns GPs and hospitals, things like that, received a proposal valuing it at just under 1.6 billion from a consortium of KKR, US private equity giant. USH is the university's pension fund in the UK. And that price at 48p was at a massive premium to its share price. It just goes to show how wide it's been sort of trading compared to its NAV. And it was a just under 3% discount to the NAV, or its last reported NAV in September. Now, they said they've been working on this for like 6 months, and this is the fourth offer that they put to the board. The board rejected it, stating that it materially undervalues the company and its prospects. So we go on to the next slide. We look at what they've said. So it appears that that rejection may put this to bed now, with this bid anyway. USS has pulled out, saying that they're not going to consider another bid with the consortium or even on their own. KR hasn't gone that far, but and said that they're sort of considering their options, whether to engage with the board any further. They've got till 14th of March to make their intentions known on whether they're going to make another bid or not. So we'll wait and see on that. But just looking at Assura's portfolio, so we've had this sort of ridiculous period over the last couple of years where, because of inflation and things like that, they've not been able to develop the health centres that they wanted to because they can't get the rent past the district valuer. District valuer is sort of turning them down. They've had to increase their rents, obviously, because of inflation, building materials and things like that. So there's just been this impasse. Their portfolio was stagnant for a long time. But last year, they decided to take action to sort of get some growth going again. In May, they entered into a joint venture with USS, interestingly. I don't know how that relationship's going to move forward. An 80 to 20 JV. USS holds 80% of the equity, Assura 20. It was seeded with 7 of Assura's portfolio properties, and they'll look to grow that to 250 million in 3 years and potentially up to 400 million with USS's money, basically. And Assura will take management fees, asset management fees and property fees, stuff like that from this joint venture. So that was good news. And then later in the year, in August, they did a deal to buy private hospitals, 14 of them across the UK. Massive deal, 500 million. It sort of diversifies their portfolio now. So they've not just got sort of NHS stuff and GPs and pharmacies and the like. They've now got private hospitals, which we all know is playing a massive part in the healthcare sort of solution in the UK. So top tenants, there's a typo there, but it's Nuffield Health, Aspire and the like. Massive long-dated income to 26 years, fully repairing and insuring leases, which means that the tenant is responsible for sort of repairs on the properties and insurances and stuff like that. So Assura doesn't have to pay any of that stuff. 100% inflation linked, annual reviews capped at 4% and collared at 1%. And it funded it through issuing 100 million of shares to Northwest, massive new debt facility, drew 80 million from its RCF, which is quite expensive, and then some of the cash they already had on their books to pay for this. So that has seen their LTV. Well, actually, sorry, this slide just shows that the portfolio now and how diversified it is with this private, which is the green area in the bar chart to the right. Now, quarter of their income is from these private hospitals. And GPs are now down to half. But this deal, obviously with the issuance of the new debt and RCF and stuff, took their LTV to just under 50%, which is quite a lot in today's times compared to its peers. The cost of debt is still pretty good at 3% and it's 5 years maturity. But to address the scale of this debt, they've started a £200 million disposal program, and that will repay that expensive RCF and reduce the LTV down to below 45%, which is still fairly quite high, but more palatable. And so what next after this deal was rejected? Well, we'll see if KKR come back with another offer or even indeed another party comes in. I feel like if a board rejects an offer like this, they have to come out and say and justify it really. All they've come out is said that they feel it undervalues the company, but they've not really come out with a big sort of reason or rationale behind that or anything. So I think they need to come out and say what the actual growth plans is here and why this bid was rejected. And it also brings up the merger, which has been long muted for as long as I can remember, actually, that they should merge with PHP, which is a direct comparison. They own pretty much the same things. GP centres across the UK. Create a massive company, 6 billion portfolio to 2.6 billion market cap. That, who knows, that may bring that forward now to sort of try and keep it going out of private hands. And then Home REIT next. So we all know the story here by now, I would have thought. So they've been marketing their remaining portfolio, which I think I talked about a few weeks or months ago now. But they've received some offers in February. And they say they're credible parties, they're on to the next stage, and they'll use these proceeds to go give back capital to shareholders. But that's obviously complicated by the litigation that's going on with a group of shareholders against them, but also them against the former manager, Salvarium, and also the FCA. So the timings of this and how much this is going to cost is all going to impact on capital back to shareholders. Just a quick one on results. So they've been delayed again. They kept push back, but so now they're saying that they're going to be published in the second quarter of this year, so any time between April and June. Trading in their shares will be suspended until that happens. Interims that still haven't been done are expected in March and April. And yesterday they had an AGM where nearly 45% voted against adopting the accounts from 2023, which just shows the sort of frustration that's going on here. So we'll see what happens there. We'll hopefully get a decent sale of their portfolio and get some closure on this.
Thanks, Richard.